Welcome to the Easy Investing Income YouTube channel. This is a YouTube channel where I like to teach people how to sell options. I believe it's one of the greatest ways to make passive income. Today I want to share with you my trades last month. It was probably my best month ever. I'm going to talk about what strategies I use, how I use my cash, and actually go over my trades at the very end of the video. So stay tuned. I think you're really going to enjoy what I have for you. Now, at the beginning of most of my videos, I do like to do a quick market update. I don't really have much to add this week compared to last week. The CPI did come out and it showed inflation was up a little bit more than expected, or maybe a lot more. But a lot of it relates to energy and the fact that oil has gone up so much recently. And I don't think it's going to impact the Fed. I do believe we're going to stay with the current rates. I don't think they're going to increase anytime soon. We may be done with raising rates. I know the 10-year did go up a little bit, but then by the end of yesterday, it had come back down and I believe was below what it started at. So, and that's kind of an indication that the long-term rates really haven't gone up hardly at all. And personally, I believe that's a lot of the economy is looking out long term, and they're seeing rates in the 4 to 5 to 6%, not higher than that. So personally, I just think we're going to stick to where we are. Now, we do have some economic headwinds. I know a lot of students are getting ready to start paying their loans. That's, I believe, taking effect next month in October. I do believe the car market is still having a tough time. I know the auto workers are looking at potentially going on strike, and if that happens, that may also impact the economy in a negative way. A lot of it depends on how long they stay on strike and what kind of deal they make, but it definitely will have an impact. And then also with China, I'd still think China's kind of in disarray. They're actually going through a tough time. I had talked about this in previous videos, but the fact that their one-child policy really is coming back to haunt them. Their workforce is rapidly aging faster than any country out there, and a lot of companies are pulling out of China. And the companies that are still there are definitely having an impact supply-wise. One big one is Apple, so I'm actually waiting and keeping an eye on Apple. I really like it more in the 140, 150 range, even though right now I believe it's in the 160, 170 range. So that's my quick spiel, my 2 cents, and as usual, it's probably only worth 2 cents. So let's go ahead and jump into the main stuff I wanted to talk about in this video. So for me, the way I do my option trading is it's slow and steady. It's picking the right kind of companies. I will go farther out with a lot of my trades compared to some people who like to do shorter. But I've been able to roll a lot of my trades earlier. I've even rolled some recently that are expiring in November, and I was able to roll them and still make really good premium. So I'm okay with going a little farther out. By going farther out, you can usually pick up lower prices. So let me just give you for instance, if you're looking at a $60 stock like Coca-Cola, I think Coca-Cola is right around 58. If you do a monthly expiration, so you look at 30 days, well, the delta I like, especially for puts, it's around a 15 delta. Now, it could be anywhere from 15 to 20, but I usually like to stay below a 20 delta. And if you only go out a month, well, the price may be 57, versus 60. Now, if you go out 2 months, well, you might be able to use a strike of 55 for that 15 delta. And if you go out 3 months or 4 months, you can go lower and lower, taking less risk. In my mind, when I find a good stock and I know what price I want to pay for it, then I like to start with a strike that's at that price I want. And usually for me, the price is pretty close to the 52-week low, if I can get it near there. Now, there's some great companies that grow consistently, like Cisco, and it's really hard to get anywhere near their 52-week low. So with companies like Cisco or companies who are doing really well, maybe in the middle of that 52-week range, but maybe a little bit on the low side, but not necessarily at the 52-week low. And then I also like to look at their PE. Are they growing? Are their revenues long term and their income growing? I also like to look at their debt. I like to see how much debt they have. Are they paying dividends? I prefer companies that are paying dividends. But even more so than the yield for the dividend, I want to see them growing those dividends. So I look at all those things. I pick really good, what I call value dividend growing companies. So, and if they can pay dividends and they don't have a lot of debt, then I think again that means they're a very well managed company. Most companies have a fair amount of debt, and with these higher interest rates, that's definitely a hindrance on those companies. So those are the key things I look at, and sometimes those companies aren't the ones with the best premiums. They're not the AMC that has crazy premiums, but it's partially because it's so risky. I know Palantir, AI, some of those have more premium. But I personally don't invest in companies who aren't making money. So I typically look for companies that are making money, and then also are at a point where they're not way overpriced, that they have a 50, 60. Say the PE average for the industry is 20 and they've got a 50 PE, then I'm going to stay away from that company. So what's really critical is picking the right companies at the right price. And typically I do look to see if they're optionable. There are some investments, some mutual funds that I have that aren't optionable. You can't sell options on mutual funds. But they've performed really well that I keep them anyway. And then what I've looked at recently that I've begun to do is look at different guidelines by asset type. So I typically have said 15 delta on put and 20 some delta on calls. Now I'm changing that. I'm going to do a slightly higher delta on the puts when it's an ETF. So I'm thinking something like an 18 delta, maybe as high as a 20 delta on ETF puts. And then for ETF calls, maybe a little bit higher than a 20 delta. Maybe I'll go to a 25 delta all the way up to a potentially 30 delta. Mainly because ETFs don't move as much, especially the ETFs I like to invest in. I like to invest in IWM, IJH, IJL. Those are related to, again, smaller value companies that are in the S&P 500. They're not SPY, but they grow fairly well long term, but they don't move in a crazy manner compared to a individual stock. Someone like Tesla just goes way up and way down, literally almost on a daily basis. It could be up 10 points one day and 10 down 10 points the next day. So I do believe that, a different delta or a different risk factor for each security is well worth it. And like I said, that's what I'm looking at, and that's what I'm going to probably continue to do going forward. Next is selling options an art or a science? I have a lot of people that want to know specifically, well, what exactly do you do? What amount of cash do you keep? What amount of, almost to the point where they feel like it's a science. From my own experience, and this is my opinion, I feel like it's more of an art. It's not necessarily, coming up with the technicals and understanding the technicals 100% are going to mean you're going to be a successful trader. To me, it comes down to picking the right companies. It's important to know the basics of the technical analysis as well as the fundamentals. You really need to understand the fundamentals of company, what makes a good company versus what makes a poor company. And also kind of the technicals of, is the stock, if you have a feeling for a stock and how it trades, is it way above where it should be based on, past experience, or way below where it should be based on past experience? So in my mind, again, it's more of an art. And that's also another reason not to diversify too much. I find that sticking to a core group of companies, you can really get a better feel for the technicals as well as their fundamentals. And you can really pinpoint when it's a real buying opportunity. And there are a lot of buying opportunities. I believe, even though the market's been up quite a bit recently, it's the top 6 companies, especially in the S&P 500 and NASDAQ. You're talking Google, Apple, NVIDIA, Amazon, Meta. There's one other, I can't think of it right now, but those 6 companies, they've they've had more gains, almost like 21, but not quite as much. So there's still some great opportunities out there, some companies that are not overvalued that you can still pick up at a good price. And then next, that kind of causes me to jump into another key point. I get lots and lots of questions on how much cash, you need to start selling options. And again, this is more of an art than a science. It's in some of my accounts, which are fully funded, meaning these are brokerages I've had going back into the 80s, and I've had stocks that literally go back to the 80s that are have very small cost bases. So in those accounts, I primarily do covered calls, and I may do a few puts here and there, but mostly covered calls. I don't need quite as much cash. I'll keep a certain amount of cash, usually more like on the 5 to 10% range of the total account value. So if it's a $100,000 account, I might only keep 10,000 because again, primarily I'm doing covered calls and a few cash secured puts or vertical put credit spreads. I'm definitely not doing a whole lot. Now, I do have another account. I like to refer to it as my IRA with options, and for it's the main account I'm using for selling most of my puts. And for that account, which is also fairly close to 100,000, I think it's right around 96, 97,000. I've got, I believe, pretty close to $43,000 in there. So it's like 44% cash. Now, can it cover every trade if the market dove 40% and everything got assigned at the same time? No, without a doubt it couldn't. But it does cover literally every position I have, every spread that I have, to be able to close those spreads and get out of trouble. I had something like that happen back, I guess it was October of last year, and I had 2 or 3 stocks get assigned at the same time, but it's pretty rare. Now, it can happen if the market does like a 30, 40, 50% dive. But I have enough securities in that account too that I could liquidate a few things. But the chance of that happening is so very slim. Now, I typically at any point in time maybe have 10% of my positions that are in the money. The big one right now is Square. It's probably the deepest in the money, and I have plenty of cash to deal with it if it's assigned. And then typically, if I have 3 or 4 others get assigned at the same time, I'm perfectly fine. But again, if the market does a 40, 50% crash and everybody gets assigned at the same time, none of us are safe. Actually, the market would be going through some major turmoil. Now, overall, for all my accounts, when you look at my 5 different accounts, I have more like 15% in cash, and I probably will look to increase that. I may look at trying to up that a little bit, but in the past I've typically had plenty of cash, even when the market went down last October so much. But again, more cash can't hurt. If you're able to keep more cash and do okay, and you're happy with your performance, then by all means keep more cash. So I just wanted to mention that again because I get so many questions about cash, and there's no one answer fits every situation. If you're starting with a complete, account that just has cash, then, you could trade in it until you reach a point where you feel comfortable. That may be 50%, meaning, you still have 50% available, cash available, or maybe 40% or 30%. I'm more risk averse, so I prefer less risk and a little bit more cash. So there's probably a lot of people out there that probably take a little bit more risk than me and keep less cash. And there's some on the opposite spectrum too. So those are the kind of the main points I wanted to talk about in this part of the video. Next, I'm going to kind of dig into this a little bit deeper. I'm going to share my trades for August, and I had 23 trades, and it was one of the best months. I realized I had made a mistake in my spreadsheet, and I hadn't carried over some of the profits, and actually turned out to be my best month ever. I did a little bit over 5,000 last month on 23 trades, so we'll talk about that. Before we jump into that, as always, please subscribe, hit that like button. If you're curious about my memberships, details will be below. I've had a lot of people joining. I'm doing a lot of coaching calls, so I encourage you to take a look at maybe something worth your while. So that being said, let's go ahead and jump into the next part of the video. Okay, now I've opened a new spreadsheet. This is one I set up. I pretty much use my planning worksheets for the whole month of August and condense them into one spreadsheet. So I'm just going to kind of start from the top. I'm going to talk about, so the first trade is Polaris. And I've been trading with Polaris for a while and it's really worked out well. I rolled this position that originally I guess I put in back in May, 95.85. At the time it was 110 when I did the roll, so it was still very far outside the money. And I rolled to the same strikes. They were still in that range, that delta range I like, which is close to 50, what is it, 15 delta. And I brought in 172.80, which is like a 32% yearly return when you look at DTE and how many days it was active. So that's the first one. Next is SDY. This is a covered call. This is one of the ETFs that I currently have, but I'm looking to get rid of it. So this is one that's an exception to my typical guidelines. Since I want to switch to SCHD, I'm selling covered calls at a much higher rate on SDY. Once it's assigned away from me, or it's called away from me, I'm going to look at actually selling puts on SCHD because I prefer SCHD. SDY is also a dividend-based ETF, but it's not my favorite. So the short strike was 126. The current price 121. It was expiring 10/20, and I rolled it out to 119.24. Kept the same strike. Again, it was a much higher strike than I typically do. I believe it was in the mid 30s, maybe close to 40 delta. I brought in $345, so a good amount of premium. This translates into a yearly return on investment of 5.82, which is more than the dividend. It's not double the dividend, but it's quite a bit more, maybe 1.5 times. But again, like I said, I'm trying to get rid of it. eBay is another one that I sell covered calls on. It was expiring also 10/20 with a $50 strike. Its current price was $44.39 at that time. I rolled it out to 119.24. So you can see here in August, I was rolling positions that were expiring in October, and it worked out quite well for me. For this, and these were 2 contracts. Each of these are 2, I believe. I brought in 173. This is the cost basis for my eBay. And then it was like a 4.5% dividend or ROI, which again, for cover calls, I'm trying to double my dividends if I can. So if it's paying a 3% dividend, I want to earn at least another 3%. In essence, doubling the dividends. At least that's my goal for covered calls. And I didn't come up with that. That actually was another pretty well-known option trader. I believe it was Tastyworks might have mentioned that, but it's worked out well for me. I typically have been able to double my dividends with covered calls. Actually, even a little bit better. I think it's between almost tripling in a lot of cases. So here's another one, Cisco. These were assigned to me, but I really like Cisco. So it was 55 expiring on 10/20. It ended up in the money, got up to 57.40. And then I rolled it out to 419.24, 57.50 was the new strike. I brought in 229.40. And this, again, the yearly ROI was a little bit higher than the dividend. I think their dividend is right around 3%. So that worked out well. Cisco, I think, is now like 60, what is it, 56.50, or it's not quite 57.50 anymore, so it's out of the money. Devon, I've got 4 of these contracts. I actually combined two different positions into the expiration on the same day. That's why I have 2 different dates there for initiation. But they were all 50/40, which has been pretty close to the money. And I just rolled it out again to 50/40. I'm perfectly fine with owning these. So I am taking a little bit more risk with it. I probably could have lowered it a little bit, but I decided to go ahead and pick up the premium because I definitely do want to own Devon Energy. And I brought in $553, and the required margin was 3,446, which is just the 4 vertical put credit spreads, which translate to 4,000 minus the 553.60. And this is like a 39, almost a 40% return. I've done really well with Devon, and it typically will get slightly in the money and then come back out, get slightly in the money and come back out. But overall, I've done quite well with it. Now, IWM, that's the Russell 2000. These trades, I typically don't plan on owning IWM. So if it goes against me, I will definitely close it and take a loss. But so far, that's not happened. I mean, it hadn't even come close. I think every one of them I've been able to roll or has expired. So these are 2 vertical put credit spreads. This is a new trade with 165.50. I do like that between 160 and 170 for the short, and usually between 150 and 160 for the farther out put. And it's worked out really well. It was originally expiring, or this is a new one, so it's expiring on 12/15/23. I brought in 183.96, which actually that was the current price. The premium I brought in was 207.40. This is the required capital, and it's like a 36.4% return. So, and I do IWM a lot. I may end up doing it even more, mainly because it's worked out so well for me. Next to Truist. Truist has been hit hard again with the whole banking crisis. So this is a roll. It's a vertical put credit spread. 25.15 is what I've liked with them. I've been able to do quite well with them. And it was expiring 9/15. I rolled it out. It was 28.20, so it was pretty close to that 25 strike, which is really low for them. I mean, they're paying almost an 8% dividend at this $28, $29 price. So I rolled it to 119.24. Same strikes, 25 and 15. And I brought in another $200. And this also is like a 27.1, 16 yearly return. So, and the 25.15, I've done quite a few trades at that level, and I've rolled it a number of times. So it's worked out quite well. Here's another IWM. This was in a different account. This was an iron condor, which recently I started to do more iron condors and what I call reverse jade lizards, which is another iron condor, but if you already own the shares, you don't need to buy the call. So it's a vertical put credit spread paired with a covered call. And that'll be the next trade I talk about. But I'm also doing iron condors on IWM. I feel like it's pretty safe. So the 2 shorts were 204 and 163. The 204 is really close to its 52-week high. Actually, it's above the 52-week high, and the 163 is below the 52-week low. And then the outers are 214 for the call and 153 for the put, which right now it's like 185, I think today. It got up to 185, 186, so it's like right in the middle. And that's what's happened. I think this is the second iron condor I've done, and expiring on 11/17, so I didn't go out quite as far as I typically do, and I brought in 247, which is nearly a 60% return. So, and again, the required margin or capital was 1752, which is just the spread. And when you're working with an iron condor like this, the way I've looked at doing it or calculating the required margin is using the put end, and that's literally the $2,000 spread minus the 247.80. So at least that's how I've done it, but it's one of my better returns. And then the Jade Lizard, same thing. And this was with Coca-Cola. So with me owning a lot of Coca-Cola, I did a 65 call and a 55 short put. And then the outer put, I did 50. So I didn't really go out as far. The spread wasn't as much. And I did 2 contracts expiring on 119.24. Current price at that time was 60.48 for Coke. Now Coke has dropped. I believe they're right around 59, I believe, 58 something. They may have hit 59 today. I know the market's up quite a bit today. But I brought in 210, which works out really well. And since I've only got the $500 spread, it's a much smaller spread. So that's why that return's a lot higher. And currently it's still out of the money at 55, but if Coke has a significant drop. I should be able to roll it down, almost like an ETF. Coke doesn't move that much, not compared to a lot of these stocks. Next is WSM. This is what I did my last video on. So here's another trade with WSM, which is Williams Sonoma. Is vertical put credit spread, another roll, 105.95. It was at 140, and I increased it a little bit. So from the 105.95 to the 110.100 to get it the right delta. So again, this put it at like a 15 delta. The 105.95 was almost like a 10 delta. So I did increase the risk, and maybe I should have done more because I could have picked up a lot more premium, but I did pick up $270 in premium. And I didn't go out as far, 1117.23. And again, the required capital and then the yearly return almost 61%. So Williams Sonoma's worked out really well for me. If you haven't watched that last video, I would go back and watch it. I go over all my Williams Sonoma trades. So next is Square. This is so I have one position with two contracts that is in the money. It was at 65, and I believe Square is around 53, 54. So it's pretty deep in the money, but I went ahead and did another one. And I did this one at 47.50.40, so a $7.5 spread expiring on 12/15. So it's still out of the money, probably by $5 or $6. And yeah, at 59, so it's dropped even a little bit more. They did have an outage. I'll take this just to take a moment to talk about Square. They had an outage last week that really caused their stock to go down again. They did miss earnings slightly. I like the company. I think they're going to do really well long term. And then I've done a little bit more research as to what happened with them. They had a DNS issue. They did some upgrades, and because of the upgrades, they had some DNS failures. So the system went down for, I think, maybe 24 hours or 12 hours. But a lot of businesses were impacted. And from what I can tell, what they shared is real positive, that they've learned from their lesson. And almost every company I'm aware of have had these kind of issues. I know Google's had it. I believe most, even Microsoft or some of the other companies have had similar issues like this and learned from it. So 207.40 I brought in with this trade, so very profitable, and almost a 48% profit with it. So next, so you can see we're already up to 13 BP. This is a covered call, 41. I rolled it, expiring on 9/15. It was at 36.22. I rolled it to 119.24. And again, this was back in August. So here I am again rolling stuff that's nowhere near expiration. I rolled it to the same, actually down a little bit because BP had dropped. And I brought in 153, and it, again, with it being a covered call, I did better than the dividend. I believe their dividend is like almost 5, not quite 5%, I believe. Okay, let's go to the next one. This is Camping World, CWH. It's one of my only cash secured puts currently at 22, and I rolled it, expiring on 9/15. And I rolled it out to 12/15 and kept it at 22 and brought in another $165. So the return on it is a little lower because it's a cash secured put. I've got the full value. Actually, this should be I should have subtracted the 165. So it's probably like a 13% return. So next I did TFC again, another roll, vertical put credit spread. I have it in more than one account. So I rolled it. At that time, it was at 28. I rolled it to 119.24, kept it at 25.15. Seems to be a Goldilocks area. The 25.15, it seems to never quite, if it gets to 25, it pops back up pretty quickly. But I brought in 186 and I had a 24% return. So you see most of these are some of the same companies. So here's Qualcomm, another one that I really like to trade. I rolled it, the 110-100, which I think I've been working at these strikes for a long time, expiring 9/15. It was at 119. I believe now it's like 112, 113. So it seems to go like this too. And I rolled it to 119.24 and brought in $288.90, kept the same strikes. and this was almost like nearly a 40% return. So I found Qualcomm typically has some really good premium. Next is again IWM, another Russell 2000. This was a new one, a vertical put credit spread 171, 161. So this is a little higher than some of the other ones I've done. Most of them have been under 170. This one's expiring at 11/17/23, and at the time it was 191. Now it's, I believe, 184, so it has come down a little bit. And I picked up 189.40, and it's like a 37, almost a 38% return. So did well with that. Now Citigroup, this is another one I really like. I've done a lot of trades with Citigroup. I think it's just at a really good price. So this is a new one, a vertical credit spread 40/30. And at the time it was at 44. So this was a 22 delta. The one above that I was just talking about, the IWM, was a 16.5 delta. This is a 22 delta. And I brought in 167.40, which is like a 26% return. So, and I really like Citigroup. They pay a really good dividend. I think it's over 5%. Coca-Cola, I just rolled a covered call that was at 67.50, retiring or expiring 119.24. It was currently at $61 back in August. I rolled it from 119.24 to 621.24, and I find myself doing this a lot especially with my Coca-Cola. I'll move these around. Sometimes I'll lower the price. Sometimes I'll close a lot. I believe earlier this month, 2 weeks ago, I closed 7, 8, 9 positions in Coca-Cola. But by just rolling it out to the same strike 6 months, and again, this was back in August, I still picked up another $200. And then the cost basis is very low for Coca-Cola, so that's why this is such a higher return. I've had Coke so long that, I mean, a lot of it I picked up when I was a teenager from my grandfather. So the cost basis is crazy low. So that's why that return is a little higher than what you typically do. Next is BBY, which is Best Buy. I rolled it, vertical put credit spread, 70/60, 22 delta originally. And I kept it at the same. I just rolled it with the same strike, 70/60. From 9:15 to 12:15, brought in $202.80, and this was also another 32% return. Okay, next, Square, and this is a new one. This was new when I did it. I did this one before the 47.50 one that I talked earlier. This is the one that's in the money that currently could get assigned to me at any time. So I've actually upped my cash just in preparation for when it does happen. So I have plenty of cash to cover the assignment of 200 shares. And at that point, if it is assigned to me, my cost basis would probably be closer to 63. And then this 55 put that I purchased, I should be able to sell it and pick up another maybe $1 or $2 per contract. So another 300 or 400. So in the end, my cost basis would be probably pretty close to $60, which I think they're going to be there or back in the mid 60s later this year. Now there are 2 contracts, so I could also sell 100 shares if I needed to lower the risk, but currently I'm planning to keep them all. I really feel fairly good about Square, and this was a 16 delta at the time, so it was using my standard. At the time, it was 78.50, so it's currently like in the low 50s, so it's really dropped majorly. Now, what's surprising to me is they've been hammered. Then you've got companies like Roku who have tons of debt, aren't making any money, actually having higher losses, and they're doing really well. But Square's making good money. Their PE is pretty good, and their growth potential over the next couple of quarters is fairly good. So it's just weird. Sometimes companies that don't make money, for some reason Wall Street really likes them, which is kind of crazy to me. But this is a 68% return. Of course, this could end up being a bit of a loss once it's assigned, but we'll see. It may recover. The current expiration's 10/20, so it may recover before then. We'll see. And then ASO, this is Academy Sports. This is a new one, a vertical credit spread 47.40, so a thinner spread, 18 delta, expiring on 1/19/24. It was 57.58 at the time. Now I believe it may be 50 or 49. It's dropped significantly. I brought in 217. It's almost like a 38 yield on it, 38% yield on it. So I really like Academy Sports. I think long term they're going to do really well. I use them. They're near me, so that's partly why I like to invest in PayPal. Almost like Square, they also got hit and they dropped big time. But this is a new one I did at 55.45. I believe they're over six. They may be like 63 currently, but this was a 16 delta expiring in 11/17. They were 65.29 at the time. Now I believe they're like 63, so it's still very far out of the money. And I picked up some good premium, 207, which translates the required capital 1792, and it's like a 40%, almost a 40% return, just shy of a 40% return. And then overall, I did 5,005 or 56.40 for the whole month, which is my biggest month. And part of that was an accident. I had a mistake in one of my planning worksheets, and I thought I was $400 or $500 lower than what my goal was going to be, and then I realized I had that mistake. So I do think it'll probably impact me in September. I may not have a 4,000 month, but so far I'm on pace to again have another 4,000 month. So, and then weekly average 1264.10. So my weekly average typically is 1,000 a week, and then my average trade was 219.84. So it worked out well. And then I just wanted to share here. I've got a trade type. So 13 were rolls and 9 were new. And again, a lot of these rolls were way before expiration. There's no need sometimes to wait all the way to expiration. And most of those were profitable. So in Schwab, you can actually go to your summary page and you can sort by profitability. And I'm able to see, well, this position is 70, 80, 90% profitable. And then I'll look at rolling it because it really can't gain it anymore. And that's why I did do a lot of these rolls. And then the new trades are just good opportunities that I find. So I had 14 vertical put credit spreads, 5 covered calls, 1 cash secured put, 1 iron condor, and 1 reverse jade lizard. So worked out quite well. And then at the top, I was just going to talk about this again. So with my IRA with options, and that's my account where I do most of the trading related to selling puts, I've got in there 44% cash, and it works out well. Like I said earlier in the video, if everything went to hell in a handbasket and everything got assigned, then I would have to liquidate some of my securities and close as much as I can, but I really don't think that would happen. When I look at just my vertical put credit spreads and add those up, if I took a full loss with each one of those, meaning, the loss was the max loss for that spread, then I'd still have plenty of cash to do it. The only thing you could get in trouble is everything got assigned at once, and it doesn't work that way. Even when you have a big drop, some people might have assignment early, and typically the only times you're going to be assigned early is if you have situations like someone gets a margin call and they have to do it. But you'll have others that, I've had 1 or 2 positions that have been in the money I have had a covered call in the money for nearly 2 years, and I've got a cash secured put that's almost the same amount of time, and it's never been called. So, and then overall for all my accounts, I've got about 12% cash, 12 to 15. I did a calculation, it's 12, but I typically want to be at 15. So I'm about to have a bunch of dividends hit next month, so I should be back to that 15% level. So as always, this was a lot to cover. Sorry if I took so long. If you have questions, please leave comments. I try to answer all my comments. And thanks for joining me and hanging with me so long. Have a great day.